You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If we sound a bit different, it's because we're still coming to you from the Options Industry Conference. You know, you're saying, that's a lot of shows you've been doing. Yes, we've been very busy down here at the Options Industry Conference. And our next guest is Jerry Hanweck, the CEO at the aptly named Hanweck. Jerry, welcome to the program.
Thank you, Mark. Thanks for having me.
Jerry, it's been a while since you've been on the program. I know we had Tom on a while back, but I think it's been at least a few years since you've joined us on the network. So why don't you go ahead, for the benefit of some of our newer listeners, give them a quick overview of your background in the space and how you found your way to starting Hanweck.
Sure. We've been doing this for about 10 years now as a company. I came out of the banking side of the world. I ran JP Morgan's options strategy business, their equity derivatives strategy business in the early 2000s, and fixed income derivative strategy before that. Our focus is right now on real-time risk analytics, particularly in the options market, but in the past year or so since you've had me on, we've expanded out into other asset classes, including fixed income, FX derivatives, and some credit work. And we also have some interesting new products, which I can talk about if we have some time.
Fixed income, what is it? We don't talk about that here, Jerry. There's no fixed income talk.
We'll skip the fixed income part, but we can talk about some of the other stuff.
You know, it is good timing to have a new real-time risk platform. After all, I think particularly post February 5th, I think you call somebody on February 4th, talk to them about risk, they may be like, what do I need risk? The market's going up, the vol is non-existent, what do I need risk for? February 5th, February 6th, they may be a little bit more receptive to that call. Has that been your experience here so far in the last few months?
For sure. I think the notion of real-time risk really gets a lot of weight from events like that. People can get a bit complacent and say, well, you know, I don't need real-time or intraday, I just need end-of-day marks and end-of-day risk picture. But when you have something like that going on and liquidity evaporates as it does and the markets move as much as they did on those days, that idea of where am I right now under current market conditions is very, very important. And we're hearing a lot more of that from our customers.
Now, I know real-time has always been a challenge for the business. We've had a few people on the network over the years who've talked about different ways they're trying to accomplish that. How are you guys doing? Are you still primarily doing the CUDA platform? Is that powering all this, or is it AI? What are you doing to really get all this? I've heard some people talk about AI and real-time risk and margining as well. How are you guys accomplishing this voodoo of real-time risk, Jerry?
It's a lot of technology. It's also a lot of quant finance. We've always been strong users of the GPU platform, the NVIDIA GPU platform with the CUDA language. That's always been a core piece of technology we use, but also machine learning has become more important. Some of the analysis of the data in real time to help smooth over situations like Feb 5 when bid-ask spreads on SPX went 0 bid at 100 offered. What is the true theoretical price at that time? So the machine learning and good statistics and good quant finance, you bring them all together with the technology, and that's what we do, is bring real-time risk analytics out to people who need it.
And one of the things you guys have offered for quite some time are the enhanced feeds as well, the enhanced analytics, I suppose you can call them, where you're pushing not just not just tickers to people, not just prices, but Greeks and volatilities and things like that. I know that space has become hotly contested in the last few years. Everyone seems to be trying to up the ante on what you can push down a dumb pipe. So what is the latest from you guys at Hanweck? What is it? How much are you pushing down the pipe to people now?
So it's, we started out with real-time Greeks and vols, and that was kind of our core business for a long time. We've moved on into other areas, include scenario analysis, what-if analysis, what if the market goes up, what if the stock moves down 10% and volatility goes up. So feeding a lot of the scenario analysis information out through the feed. And then in addition, margin analytics. So margin, as capital becomes tighter and more expensive, margin as a risk measure becomes much more important for our customers. So we put out a lot of margin-related data, TIMs, SPAN, even stands for the clearing members. So that's a big new area for us, and we're finding that particularly on these days like a Feb 5th, but really any day where there's a lot of market move, buy side and sell side want to know what does my margin look like if I'm a clearing member? What does my margin look like to the OCC? If I'm a hedge fund or asset manager, what am I going to have to post to my clearing firms? And sometimes there's disagreement on those numbers, and so it's good to have a third party in there to give some objective valuation to the risk numbers, including margin.
Of that objective type of valuation, margin and just capital rules in general are a hot issue at this conference this year. Everyone is talking about them, particularly on the market making side. They've become somewhat onerous in terms of the requirements for how much capital they need to put aside, even for something like a simple $5 spread, where the risk that doesn't matter from the margin capitalization component. So I'm sure maybe a platform like yours that can provide some sort of real time insight could be useful. Maybe even in that argument to say, hey, here's what we probably think we really should have to set aside for this. It could be max risk of $5 versus your notional things. Are you seeing a lot of interest and uptake as a result of that? Hey, we want to use your platform as a way to maybe figure out what we should actually be allocating versus what the capital rules are telling us we need to do?
There's one area we call it margin attribution, where let's say a clearing firm wants to know, what is a particular customer, one that they're clearing, what is that costing them in terms of capital? Is this customer risk additive? So are they bringing a lot of risk to the portfolio, and therefore the clearing firm might want to charge them a bit more? Or are they actually risk reducing or kind of a risk neutral type of customer that's not going to cost the clearing firm a lot of capital? So margin attribution has been a very hot topic of late, and I think as capital costs continue to get higher, which they will, particularly as rates go higher, then this becomes even a more interesting issue. In addition, we look at things like collateral optimization. What does one post to the OCC as collateral to optimize the amount of collateral and capital that they have to post to the clearinghouse?
You mentioned OCC. They were in here earlier talking about some of the issues facing this conference, like liquidity. It's a big topic everyone seems to be talking about. And it does seem like there is some interesting consensus finally on some steps that could be taken to perhaps mitigate this problem and provide some sort of relief to the market makers, and who knows, maybe perhaps even lure a new firm or two into the space. Things like strike mitigation, quote mitigation, the margin capital rules are certainly a big one as well. You obviously interact with a lot of trading firms and you provide a lot of their real-time risk, a lot of their margin calculations. So you're interacting with them on a very functional level. I'm curious, what do you think we could do as an industry to really maybe foster that community a little bit more and try to incentivize some new firms to maybe enter that space as opposed to the way it's been heading for the better part of the last decade?
A lot of I think somebody at the John Fennell's panel yesterday brought this up, that it depends on who you ask. And if you go to a market maker, they're going to have a very different view, say, from a buy-side shop. One of the things that's interesting did come up is bid-ask spreads and penny pilot and what can be done to make the market makers a bit more profitable, to lure some of them back into the space. And it's interesting, CME went through this a number of years ago, probably about a little over 10 years ago, when they actually increased their minimum tick width on the bond and note futures. And it was a bit of a shock to some people, who were thinking, well, why would you widen that minimum tick? Why would you make that minimum tick size bigger? And it was for that very reason that both the buy side and the sell side wanted it. The liquidity providers obviously wanted it because it gives them a better spread. But the buy side liked the idea as well because they could get bigger visible size on the bid and the offer, even though maybe the total size available under smaller tick size was roughly the same. They had more certainty when they could see, these are futures contracts, right? So 1,000 aside as opposed to 100 aside on a smaller tick. So, that's certainly an area worth exploring, and I think the industry is looking into that in depth is to address the penny tick and see what they can do to widen that out.
It's funny, they've been calling it a penny pilot. It's been around longer than our Options Insider. It's been over 11 years now. As I was joking with someone on the show, I think it was Shelley Brown from my ex, I said, well, can we stop calling the thing a pilot? It's been around for over a decade. And he said, wait, hold on before you say that, because that makes it harder to change it, obviously. If you stop calling it a pilot, then it's real, it's official, and then it's hard to dial it back. And so I think everyone realizes there probably is some interest in dialing that. There's a lot of names out there that probably shouldn't be quoted in pennies. And you're right, it doesn't behoove anyone to have a penny-wide market if it's 3 by 10, But if you can get a couple hundred or a couple of thousand by a couple of thousand, a nickel wide, then that's certainly a more attractive thing. And it's a little bit wider, but also more size, so people might actually want to come and trade it. Well, you kind of teased us with some interesting new products coming down the pike from Hanweck. I think you gave us a little bit taste of a couple of them, but what are you guys working on over there? What's the secret sauce coming out of Hanweck these days?
So, aside from the margining and some of the other asset classes that we're addressing, we have a new series of products. We call them trading indicators, and the genesis of this was to try to take as much information out of the options market as we can, digest it into a form that's useful not just for options traders, but for equity traders and even credit traders who, don't have either the understanding or the tools to look at the, massive U.S. equity options market and extract information. So, two of the trading indicators that are hot right now. One is we call it borrow intensity index, and this is an index of stock borrow loan rates that we compute off the options market, and then we normalize that data, clean it up, smooth it, because there's a lot of noise in that information, and then produce an index where you can see, is this particular stock getting harder to borrow or easier to borrow according to the options market. And the benefit there is the options market, unlike the stock borrow loan market, the options market is longer term and certainly forward looking, whereas the stock borrow loan market is a bit, everything's practically overnight, and you don't get a lot of visibility into the future beyond that overnight lending. So, here we can pull up stocks like Tesla and things of that nature and say, what does all this mean according to the options market where people are putting real money down on these things?
That's always a more reliable indicator at the end of the day, right? Where real money is actually being transacted versus you call some random stock loan broker, and then they're going to give you some random quote on some random day, and you have no idea how representative that is of what the market really is. But you're right, that data is there and reflected in aggregate in the options market if you're savvy enough to intuit it. So yeah, I definitely prefer any sort of real-time, real money indicator than some sort of abstract stock loan measure that people are quoting around there.
And related to that, we have kind of next in the queue is probability of default as implied by the options market. So what's the likelihood that a company is going to go bankrupt, or really what's the options market telling you the likelihood of this company's stock going to zero? And that's you get companies like
Tesla's another good one, probably.
Yeah, exactly. Yeah, I hate to beat up poor Elon.
The biggest open position, I could say it right now from memory, in Tesla is the January 2019 50 put. There's like 150,000, 50,000 of those open on that. By far the biggest strike open in there, which probably says a little something about someone's committing. And it's been that for about a year, which is kind of fascinating.
Yeah. So the options market contains a lot of information about that, and with the drying up of liquidity in the credit default swap markets, single name in particular, there is not a lot of information out in the credit world around some of these companies. Corporate bonds don't trade very frequently, if at all. You don't get this kind of intraday quotes on these things, and the CDS market for single names is pretty much non-existent. So, the options market's a great source of real traded information. what are these people saying the likelihood of, Tesla going to zero is? And, these numbers are small. They're like CDS probabilities. You get these 5%, 4% type numbers over a 5-year history, or 5-year window. But it's it's meaningful, and as those numbers move around, you get a real-time picture of that from the options market that you certainly don't get from the credit markets. And that's very useful for certainly equity traders who are looking at downside risk, tail risk. Someone brought up at one of the panels yesterday that equity long short funds are you boil them down, they're really tail risk traders, and that's very useful for equity long shorts to be looking at this kind of information, both stock bar loan and the probability of default. But then more niche markets like credit traders who need another indication of what's going on and names that they're trading the corporate bonds on. So we think that's going to be interesting. We've launched this product a few times in different fashions. Worked with JP Morgan on it a number of years ago, and have made variations on it. So we should be launching that one pretty soon.
And is that solely available to institutions, or maybe is it going to be some sort of a scaled down version that your active retail guy, if he wants to be able to derive this sort of indicator information from the options world, they can maybe subscribe to something like that too?
Yeah, I think the best way to do that is going to be through the retail brokers, and
so broker platforms will have
broker platforms. Yes, so that's one of our. We sell primarily to institutions, so the institutions that we do sell to are in fact some of the big retail brokerage firms. So this is some of the data that we've been talking with them about getting onto the platform through the feeds, not just some of the other data we provide them, but also these trading indicators.
Yeah, because I know brokers are hungry for any sort of information that could lead to idea generation, which could lead to darts, right? So anything along those lines that they could have that's automated, that's pulling data from the marketplace, doesn't get them in trouble on the recommendation side. It's like, here's just what's publicly available in the marketplace. I think they probably would be beating a path to your door there, Jerry.
We hope so. Yeah, we hope so.
Well, Jerry, it says great to catch up with you here at the conference, talk a little bit about real-time margining, real-time risk, some of these other fancy, interesting indicators you guys are putting out there. Before we wrap up, though, if there's anything else we didn't hit on, maybe it just came to you now, or perhaps you just gave us some good teases. Maybe there's one more you want to leave our audience with in terms of what's coming down the pike from you guys at Hanweck. Now is the time, sir. The floor is yours.
No, that was about it. It was it's great to be on the show again, and really appreciate you guys giving us the time to tell people what we're doing.
And where can people go if they want to learn more about all things Hanweck, Jerry?
It's pretty easy. www.hanweck.com, and we do have Twitter and LinkedIn and other social media as well.
And Hanweck is Hanweck for all you out there looking to spell it out there. Well, Jerry, it says great to catch up with you, and look forward to seeing how these feeds and these indicators play out in the marketplace in the coming months.
Thank you, Mark.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.